John, Graham, thanks for joining us at our latest Inside Stephensons episode. Tell us a bit about who you are and where you're from.
Yeah, so I'm Graham Jones, one of the directors at Ebor Mortgages, joined by John Nurden as well, another one of the directors at Ebor Mortgages. There's Nick as well, who's another director. So we are an independent mortgage brokerage based in York. We've been going for 2.5 years now, just over 2.5 years. We've all come from a background of a few major banks, a few building societies. That's where we cut our teeth really, and then moved into the independent world, the brokerage world, a fair few years back. And since then, we've worked together at different companies, and now we're all working together at Ebor Mortgages.
And how are you finding the financial world?
Yeah, do you know what? It's a lot better than it was towards the end of last year. So, don't think it's a secret that sort of September, October last year were pretty tough for us and for a lot of people in general. We had the whole sort of Liz Truss debacle, which sent mortgage rates spiralling. And, it was a turbulent time, and there were times where we didn't really know what was going to happen. But over the last 4 or 5 months, things have settled down, and we're sort of starting to see a little bit more of normality return.
And you think the appetite's still there?
Yeah, people are still wanting to buy, and I think, sometimes living in York, we can feel a little bit like we're in a bit of a bubble, but we do definitely still see people looking. First-time buyers, I think especially, for them, interest rates are more expensive than they were, without a doubt, but for a first-time buyer, what they really care about is the monthly payment.
Yeah.
So for them, if they are facing a choice of renting a place for £1,000 a month or being able to buy their own place for £1,100 a month, whether the interest rate's 2% or 5%, for them, does it really make that much of a difference? I'm not sure.
Can you give us a bit of an overview as to what sort of is your day-to-day sort of role and bits and bobs?
Yeah, absolutely. So, we deal with clients in York, but we deal with them nationally as well. So, there's a variety of different ways that we can speak to clients these days. And you don't have to be in York for us to help them, really. But we do all sorts of property finance. So our main area of business is residential. So main residential, so if you're a first-time buyer, if you're moving home, if you're remortgaging, coming to the end of your deal. But there are other areas that we look at, so buy-to-let, investment market.
Sure.
Other smaller areas as well, so equity release.
And it's not just in York that you are, you've sort of got clients all over Yorkshire, haven't you?
Absolutely, yeah. So we're finding, as we've grown as a business, the main source of why people find us is our existing client base, and we deal with people. We have a lot of clients in London, a lot in Manchester, a lot down south as well, and it's sort of on a good service basis that we find that client base grows.
Just talking about your client database and I guess interaction. I know when I first got a mortgage, if you like, you went and sat in an office, took all your paperwork. In today's world, clearly there's a lot more online interaction. Are you still keen to sit down with a customer in front of them in their home, in your offices? Do you find that more beneficial? Do you think you find out a little bit more about the client and what they're after, or is it mainly over?
It completely depends on the client. I think, if you've got a buy-to-let landlord who's buying the 10th property, they're probably going to be less keen to sit down and discuss things in lots of detail because, you tend to have gone over things in the past and it's more of a kind of a process. But first-time buyers, people like that, they're going to want to spend more time. So if there is a sort of certain type of client that we tend to spend more time with, it would be the kind of first-time buyer. But, we can do stuff either over the phone, email, video conference. We can go out to see people. So I think the pandemic really was the big shift there. Prior to that, most of the stuff that we did, we'd go out and see people. And then obviously with the pandemic, people were not so keen on you going in the house. And then it's just kind of never really reverted back. So we just find now there's just less and less demand for people wanting to do face-to-face.
I guess that kind of rolls into some of the questions that we had for you, which were just focusing on first-time buyers for a short period of time. Clearly they're really important to the market and the food chain of people moving up and down the ladder. I think one thing that really interests me is what sort of reaction have you had from, as you mentioned, the Liz Truss situation, the mortgage debacle, as you refer to it. in that period of time of a couple of weeks after that happening, people thinking that they could get really attractive rates as first-time buyers, to within a matter of weeks those rates being out of reach for many. What's the reaction been from, what have you been hearing? What have first-time buyers been saying to you?
So I think there is still big appetite out there from first-time buyers. There's still people that we spoke to 2 years ago, 3 years ago, that are still looking, that have unfortunately, maybe missed out on properties, and they are still wanting to buy. It's an achievement, it's a dream to be on the property ladder.
Absolutely.
And that is always going to be something that they want to achieve. So I think, since last October, when things went a bit array in the markets, I think there was maybe a bit of disbelief that rates may return quickly back to where they were. But, that's not happened. They've sort of, got to a level now that we haven't seen for the last 14 years. But I think with first-time buyers, they just have to adjust their budget, really, or adjust their mindset. It's, still potentially achievable, but they may have to cut back on, a few life's luxuries to squeeze that budget or make that budget work a bit more. But it is still very much achievable, and we're seeing lots of appetite for it.
And the other thing is as well that first-time buyers have I don't know whether you could say good fortune, but they don't have anything to compare it to. So it was worse.
They know, isn't it?
Yeah, the worst ones were people who were, bought maybe 5 years ago, had got a rate at, 1.5%, and then you're having that awkward conversation of it's now 5%, 6%. Suddenly your payments are going up £400, £500, £600 a month. That's an issue. Yeah. For anyone, but for a first-time buyer, like I said at the start, they care about the monthly payment. Yeah, obviously, if they could get it cheaper, they'd rather have it cheaper, but the interest rate itself is less of an issue.
I guess there's a lot of heart purchasing, isn't there? From buying with that heart round. I think as you get a bit older and you maybe go up the ladder, there's a bit more of head, isn't there, involved in the investment and the purchase. Yeah. With first-time buyers, clearly it's a daunting process. How involved do you get with them in terms of working with the agent, in terms of giving them any advice in terms of the offer that they might make or how they might present that? What are you doing for first-time buyers, and what are you wanting from them when they come to you?
I think there's always a fine line there, because ultimately, they need to be the ones that decide what they're comfortable offering, and they need to be the ones to to put the offer forward. We certainly won't get involved in a negotiation or anything along those lines. Yeah. But I think for us, it's about sort of sitting down, working out what their max purchase price is, what they feel comfortable going to, and setting a limit and working out what the cost would be based on that, and then letting them go. And if they come back and say we need to pay 10 grand over the ask or whatever, we can remodel the figures from there. But I
think really interesting, off camera we were talking about some of the things that we want from first-time buyers, if you like, and I think there's one thing that I don't know how much Tom sees it at Selby, but certainly in York we've had experiences of IFAs and financial advisors, mortgage advisors getting involved in that first-time buyer purchase, and it's not for me to tell that IFA not to be involved, but I feel a bit sad, I guess, for the first-time buyer, because that's an experience for me. It's the first time you're ever going to do it, and it's a time that I've got no problem with them doing it either way, but I've always felt that from a first-time buyer perspective, having someone in the background helping you with that proposal of that offer is really important. But I say, talking off camera, you said, what was it that first-time buyers, we want from first-time buyers? Well, build a rapport. And if your financial advisor or your mortgage advisor's in between that, then clearly you're losing that rapport between the agent and the buyer, which is going to hopefully find out some information that we can pass on to a vendor, which could make the decision a lot easier. So it's interesting to hear that you say you don't, unless they ask, to specifically take
even
that on.
If they asked, I wouldn't. Just wouldn't get involved. I just don't think it's for us to be that sort of go-between in terms of between. It then becomes sort of us acting as an agent for them, speaking to you as an agent. It's not our role. We're not there to tell them what to buy or how much to pay.
A lot of our job is educating people. So we are here. We spend a lot of time talking people through the whole buying process. So when they come to us the first-time buyers, if they want to have family with them, parents with them, extended family, that's fine. We'll sit down and take the time with them. But then we go through, from start to finish, the whole property process. So who gets involved? The estate agent, solicitors, underwriters, valuers, surveyors, and we talk them through it, and we'll hold their hand all the way through. We're not a service where someone comes to us, they've then got their offer, that's it. We are dedicated to seeing it all the way through to completion, because that's inevitably how we work.
I think the only times that we might sometimes step in and not step in and say you shouldn't buy this is where you see a first-time buyer and they maybe look at taking on a project that looks pretty, pretty hefty.
Yeah.
They've not quite got their head around exactly what might be involved.
Yeah.
We're not going to turn around and say, don't buy this, but it might just be a conversation around, look, have you really looked at what, what's involved? Do you know what the sort of the process and how it would work? In those situations, I think, we have a duty of care to make sure that people don't make a...
So whilst we're talking about first-time buyers, for any of them that might be watching this, if they're looking to buy a home and they need some mortgage advice, clearly come and see you guys. For them to help you with the process, what are you looking from them to provide to you in the early stages for you to be able to give them some as accurate figures as you can do to enable them to come into the market to buy?
Yeah, so, if we have first-time buyers that approach us, the main things that we probably flag up with them first is deposit. So where's the deposit coming from? That can be family members, can be savings, can be a wide range of places that they can achieve that from. And then credit as well. So credit has become a massive thing. Credit profiles, your credit file. You will see all the adverts on TV for credit scoring. And that does play a big part now in mortgages. So having your credit in a good position. So if you want to obtain a credit profile 6 months before you start looking, just give it a check over, see that everything's in place that it should be and there's nothing on there that shouldn't be. And then deposit-wise, making sure that you've got probably at least a 5% deposit, as that's where the products do start, those sort of ranges, to then begin looking with your search.
Yeah, and I would say another thing, that get your bank statements in order for the 3 months. I know sometimes it can be quite funny to send money to a mate with a reference on. Trust me, underwriters don't find it funny.
I think we've all been there with that
exactly,
one.
Yeah. So that they will look at something like that, and I have seen it in the past with some questionable references on, and underwriters have asked questions.
Really?
I believe people have actually had applications declined.
Because of what the reference was on there.
Someone's put something stupid on there.
I think something went viral, didn't that? Was it last year or the year before? I saw that.
You talk about getting your ducks in a row and getting your finances in order. Is that just for first-time buyers, or would you say that to everyone?
For anyone. And I think as well there's sometimes a bit of a misconception that an underwriter's going to comb through the statements and going to go, well, why are you spending 50 quid a month on the gym and why are you spending money here? And it really isn't like that. It's kind of stuff like, don't be going over your overdraft limit. If you can avoid it, don't go into your overdraft. But if you do, it's not going to be the end of the world. You probably want to avoid taking out new credit for 3-6 months before you apply. There's another misconception that people think, well, I haven't got credit, so I can't get a mortgage. Yeah. And that is just a complete myth.
How are you... Sorry. I was going to say, I was reading an article last year, they were saying that online betting can be quite bad for a mortgage application.
So I think...
What's your views on that?
If you can avoid it, or, if you do it as a hobby or something on the side, then, there's so many betting companies out there at the minute, and there is people that, have a tenner here, there on each weekend. And, if it's out of control and it causes a problem for the underwriters, if they start looking at bank statements and they see transactions every day, multiple transactions, then that will cause red flags. If it's sort of a level where it, once or twice every couple of months or something like that, may not be an issue, but it ultimately comes down to the underwriter's discretion and their risk appetite. So if you can avoid it, then I think
it comes down to plausibility with that. I think if you've got someone on 250 grand and they're spending £1,000 a month gambling, that's probably not going to be too much of an issue. It's probably not going to look fantastic. But if you've got someone on 20 grand a month and they're spending £1,000 a month on gambling, that is going to get bits up. I have had it in the past where I did have someone who was gambling quite heavily and kind of thought that we may have some issues, but the underwriter looked at it, and when they sort of balanced their account over a period of time, they were making a profit. And they kind of just said, said, well, it kind of looks like it's sustainable, and it was almost like a little bit of a hobby. So
just going back to credit, you mentioned about trying to get your credit file in a good state. I remember when I was early 20s, and there was an agent I was working for at the time. I wasn't at a stage where I was ready to buy a property, but I was asked to go and by the in-house advisor at the time to say, do you want to come and have a look at planning for the future of buying a property? And I came out of a meeting with her quite surprised, actually, because I'd never had credit cards, I didn't have any bad debt, but she sat down with me and said, go and get a credit card.
Yeah.
And I found that really strange because I'd always been brought up to be, you buy what you can afford, and if you can't afford it, you save for it, which is maybe a slightly different generation to where we are today. But her attitude was that go and get a credit card with a small limit on it, put your petrol, which was her advice at the time, every day you come to work, you put petrol in your car, put your petrol on your credit card, and then pay it off at the end of the month. And I guess it's something I've done ever since. Is that something that is going to help you with a lender?
It can, so if you do it and use it responsibly, it should improve your credit rating in theory. So it's certainly not a bad thing to do. But what I would generally say to people is that you should only do that if you think you've got the discipline to do that. Because
it comes down to the individual.
I think you stand a much better chance of getting a mortgage in a position where you don't have as much credit history versus someone who's got credit history, but actually that credit history is not that good because they took the advice of someone, took a credit card out, said they were just going to put the petrol on it, and suddenly they've gone 2 weeks to Ibiza and off we go. That's going to that is going to do more harm than it is good. So it depends how you're going to do it.
No, that makes a lot of sense. It's interesting though, isn't it, that you kind of have to go and prove to a mortgage lender before you borrow money from them that you kind of got to, in your early stages, the earlier you can start planning to prove your credit. It's an interesting world that we live in to do that.
There's definitely people who would find it difficult to get unsecured credit that could get a mortgage though, because unlike a credit card where you can rack up the go over the limit or up to the limit and there's nothing that it's secured against, ultimately you have a mortgage, there's a house there that they can come and take if they absolutely have to. So in some instances, reaching a level to pass a credit score for a mortgage could potentially be easier than certain
because they've got something to secure
credit.
Yeah. And I guess finally on credit and on how that's probably changed over the last 2 decades or so is that I guess the ability to buy cars now, brand new cars, expensive brand new cars at for guys our age, when we first started buying cars, there's no way you were going and buying a car with a PCP at 300, 400, 500 quid a month, and you turn out the garage in a 30,000, 40,000 pound car. You'd have had to have HP'd it or gone in with with cash. What's your advice to people who have maybe lived at home with their parents, enjoy driving around in a nice brand new car for the last couple of years? Would the advice be look to maybe lose that payment, or a lender's going to take it on board in terms of affordability?
Yeah, so in terms of when lenders look at affordability, they will look at credit commitments. So how high are your credit commitments, things like credit card balances, personal loans, car lease agreements, student loans, things like that. And if they are higher, or if they are there, if they're present, they sometimes will have an effect on the amount you can borrow. So you might have someone on a really good salary, but if they've got really high outgoings, such as nice cars, £800-900 on a PCP for a really nice car, that could really knock down the amount that they could actually borrow. So when you first, if you are living at home and, you don't have the overheads of your utility bills, gas, electric, everything like that, and think, I've got nice disposable income, but actually if you are planning, to get your own place, forward thinking, it's all in the planning about, right, well, if I've got that, if they spoke to a broker, 2-3 years before they were looking at buying and figured out roughly how much they could borrow then, they could then put themselves in a position for 3 years' time where they'd be like, right, I'm going to have to reduce that, or I'm going to have to get rid of that altogether.
Yeah.
So it's all in the planning, really, when it comes to it.
All comes down to, affordability. And if the job matches the car, generally speaking, it'll be all right.
Yeah.
If you've got someone who's, got a Range Rover and a relatively modest income, that's probably going to cause a problem. If you've got someone who's on a massive salary with a Range Rover, it's probably not going to cause a big issue. So it's all relevant, really.